Hello, everybody. I'm Dylan Graham of Graham Wealth Partners, which is part of CG Wealth Management. And today I want to talk a bit about what I see as a sea change in the investment world, and that's the recent rise in interest rates. Now, I would say probably for the last 40 years, we've seen a downtrend in interest rates since about the 1980s, and that's had repercussions for the equity market and for the fixed income market. It's been great for the equity market. Well, for one, businesses themselves, the cost of their capital has been going down. It's been good for equities because as the coupon rates on fixed income have been going down, that reduces the competition that they have from the fixed income market. So the equities benefit from that. So you start to see as coupon rates go down, there was much more of an emphasis on and much more demand for dividend-bearing stocks that will give you income of maybe 3 or 4%, whereas the fixed income was much below that. Of course, this has been not great for the fixed income market because coupon rates have been going down, and it has been particularly bad for income investors. And oftentimes they've been forced into the market in order to get yield when they probably shouldn't have been in there. Well, that has all changed. So I would say in the last couple of years, there's been a sea change, as I say, in the fixed income in terms of the interest rates, and they started to come back up again. So right now you can get a GIC paying about 5% for a one-year term, which was unheard of in the past. And that has kind of changed the market in total. Obviously, it really has changed the fixed income market. So a lot of people have been moving money out of the equity markets into fixed income, particularly GICs in Canada. Of course, that has affected the equity markets because that has, particularly the dividend-bearing stocks, there's been a lot of movement out of that sector itself. So the question, of course, is when will the equity markets recover? And well, they've recovered some, but when will they recover in a long-term sense and the bull market continue? I would say, in a general sense, when interest rates start coming down, the equity markets should continue to improve. They've stabilized, interest rates have stabilized, and it looks like, well, it's being projected that 2024 interest rates will come down, which is good news for the equity markets in general. Also, you'll notice that money does come out of the fixed income sector and goes into the market when there's particular opportunities. And we sort of saw that with the Magnificent Seven, which is 7 large cap US tech stocks who are seen to benefit from artificial intelligence, and they've done very well, but it's been very truncated. And I think that artificial intelligence and that theme will continue to grow and affect the valuations of many companies in the stock market. So I think that's a very important lesson for all of us, that business is one thing, stock market is another. So whereas the stock market can go down, business has to adapt and grow and be profitable. And as investors, we want to be in these companies as they adapt and grow and are profitable. As an investment advisor, my job is to get my clients into these companies that are growing and adapting and moving into profitability. Thank you for watching, and I'll talk to you soon.